Assalamualaikum warahmatullahi wabarakatuh. We are from Group 1.
We would like to discuss and to present about our presentation in modern accounting in the first chapter.
My name is Muhammad Arif Rahman.
And my name is Hadian Prayoga.
Okay, for the first presentation will be delivered by Hadian Prayoga.
Okay everyone, the focus on auditor knowledge in this chapter. We would like to discuss about auditing define, different types of audits and auditor, assurance services, level of assurance, the value of audit and assurance services. The next one, historical perspective of the demand for auditing. The next one, the factors that influence the need for financial statement audit. The next one, the economic benefit and inherent limitation associated with a financial statement audit. The public sector and private sector organization, the four components of the auditing profession, and the last one, the element of a system of quality control. So the first discussion we would like to discuss about auditing define or definition of auditing. The definition of auditing based on the report of the Committee on Basic Auditing Concept of the American Accounting Association or Accounting Review Volume 47 defines auditing as a systematic process of objectively obtaining and evaluating evidence regarding assertions about economic action and events to ascertain the degree of correspondence between those assertions and establish criteria and communicating the result to interested user. The several attributes of auditing contained in this definition merit special moment. We show in the PowerPoint. The first one, a systematic process, connotes a logical, structure, and organized series of steps or procedure. The next one, objectively obtaining and evaluating evidence. It means that examining the basis for the assertion and judicially evaluating the result without bias or prejudice, either for or against the individual making the assertion. The next one, assertion about economic action and events, the representation made by the entity or individual. Degree of correspondence. It means that the closeness with which the assertion can be identified with established criteria. And the next one, established criteria, are the standard against which the assertion or representation are judged. Criteria may be specific rules prescribed by a legislative body, budget, and other measures of performance set by management or generally accepted accounting principle, or we can call GAAP, established by Financial Accounting Standard Board or FASB and other authority bodies. And the next one, communicating the result, is achieved through a written report that indicates the degree of correspondence between the assertion and established criteria. And last one, interested user, are individuals who use or rely on the auditor's finding. In a business environment, they include stockholders, management, creditors, government, and the public. So in this slide 6, we can see the comparative summary of types of audit. There are 4 types of audit. The first one, financial statement audit. The next one, compliance audit. The third one, audit report on internal control. And the last one, operational audit. We will discuss about 4 main points, the differences about 4 audits, 4 types of audit. The first one, a session about economic action and events. In financial statement audit, presentation of financial position, result of operation, and cash flow. How about the established criteria? Established criteria in financial statement audit in generally accepted accounting principle. And the communication of result in financial statement audit, the opinion of independent CPA, and the user in the financial statement audit is investor, creditors, and the others. But how about in compliance audit? The assertion about economic action and event in compliance audit in claims or data pertaining to adherence to policies, law, regulation, and the others. And the established criteria in compliance audit, the management policy or laws and regulation. The communication result is summary of finding or assurance regarding degree of compliance. But how about the user in compliance audit? The user are management and board of directors. And how about in the other audit, especially in audit report on internal control? The assertion in audit report on internal control, adequacy of system of internal control, and the established criteria, COSO criteria for evaluating internal controls, and the communication of result is the opinion of independent CPA, and the interested user in audit report on internal control are investor, creditors, and the others. And the last one, the type of audit is operational audit. In operational audit, the assertion about economic action and events is operational or performance data, and the established criteria is objective set by management. And the communication of result is summary of finding regarding efficiency and effectiveness observed. And the user in operational audit is management and board directors. Okay, the next one is the types of audit. There are three types of audit. The first one, financial statement audit. The next one, compliance audit. And the last one, operational audit. The financial statement audit, it means that this audit involves obtaining and evaluating evidence about an entity's presentation of its financial position, result of operation, and cash flow for the purpose of expressing an opinion on whether they are presented fairly in conformity with established criteria, usually generally accepted accounting principle, or we can call GAAP. In financial statement audit for major corporation are indispensable for the functioning of our national securities market. Many lenders and creditors also rely on financial statement audit to obtain assurance about the reliability of information used to support lending decision. High quality financial audit significantly reduce the risk that investor and creditor will use poor quality information when making a variety of investment decision. And the next one, compliance audit. In compliance audit involves obtaining and evaluating evidence to determine whether certain financial or operating activities of an entity conform to specified condition, rules, or regulation. And the last one is operational audit. This audit involves obtaining and evaluating evidence about the efficiency and effectiveness of an entity's operating activities in relation to specified objectives. This type of audit is sometimes referred to as a performance audit or a management audit. Okay, the next one we would like to discuss about types of auditor. Individuals who are engaged to audit economic action and events for individuals and legal entities are generally classified into three groups. The first one, independent auditors. The next one, internal auditors. And the last one is government auditors. In independent auditors are usually CPA who are either individual practitioners or members of public accounting firms who render professional auditing services to clients. The clients of independent auditors may include profit-making business enterprise, not-for-profit organization, and governmental agency. And like members of the medical and legal profession, independent auditors work on fee basis. There are similarities between the role of an independent auditor in public accounting firm and attorney who is a member of law firm. And in general, licensing involves passing the uniform CPA examination and obtaining practical experience in auditing. So if we want to be the independent auditors, so we must test the CPA test to be the independent auditors. And the next one is internal auditors. Internal auditors are employees of the organization they audit. The objective of internal auditing is to assist the management of the organization in the effective discharge of its responsibilities. The scope of the internal audit function extends to all phases of an organization's activities. Internal auditors are primarily involved with compliance and may supplement the work of independent auditors in financial statement audit. Government auditors are employed by various local, state, and federal government agencies. In Indonesia, there are Inspektorat and BPK or Badan Pengawas Keuangan, the example of government auditors. At the federal level, there are three primary agencies. The first one, the General Accounting Office or GAO. In Indonesia, we can call Inspektorat. The next one, the Internal Revenue Services or IRS. And the next one is the Defense Contract Audit Agency or DCAA. The next one, assurance services defined. The general definition of assurance services is a broader term that includes audit and a variety of other assurances about representation of management. But the definition by AICPA is independent professional services that improve the quality of information or its context for decision maker. There are several important differences between the AAA definition of auditing and the ACPA definition of assurance services that relate to the qualities of the auditor, not just the audit process. The first one, independence. The concept of independence is a key aspect of assurance services. The next one, the concept of professional services, encompasses the application of professional judgment that is a unique attribute that the CPA brings to the engagement. CPAs bring their professional skepticism and objectively to an engagement. And the purpose of assurance services is to improve the quality information or its context. The quality, as discussed by the Special Committee on Assurance Services, encompasses the concept of decision usefulness. The decision maker is featured prominently in the services definition. Assurance services are intended to provide a benefit to decision maker. Decision makers may be client or outside third parties. The example assurance services. The first one, audit engagement. The purpose of an audit engagement is to provide reasonable assurance, not a guarantee, that the financial information is free of material misstatement. This type of audit involves obtaining and evaluating evidence about an entity's historical financial statement. The next one, attest services. There are three example assurance. The first one, examination. The next one, review engagement. And the last one, agreed upon procedure engagement. The term of examination is used to describe other services that culminate in the positive expression of an opinion as to whether or not another party's assertion conform to stated criteria. The next one, review engagement. Review engagement consists primarily of inquiries of an entity's in management, comparative analysis of financial information. The last one, agreed upon procedure engagement. Agreed upon procedure engagement is one in which the auditor performs specific procedure to attest to management assertion. For the example, the amount of royalties payable for an outside third party or the entity receiving the royalties. The specific procedure to be performed are agreed upon by the party making the assertion, the party used the assertion, and the CPA. The next one, accounting and compilation services. A CPA firm may be engaged by a client to perform a variety of accounting services, including doing manual or automated bookkeeping, journalizing, and posting adjusting entries. The CPA may also be engaged to perform a compilation services through which the CPA, who is an expert regarding GAAP, drafts and compiles financial statement for the client. When the CPA compiles a set of financial statement, the CPA provides no assurance about whether the financial statement present fairly in accordance with GAAP for the CPA has not obtained evidence supporting the financial statement. The next one, level of assurance. There are 4 levels of assurance. The first one, reasonable assurance. This is a very high level of assurance but not a guarantee. In audit and examination and judgment, the CPA needs to obtain sufficient, competent evidence to support a positive opinion that the assertion is presented fairly in a material respect. And the next one, negative assurance or review level assurance. This is substantially less than an audit or examination. And the next one, agreed upon procedure. And the last one, compilation without assurance. We can see the universe of assurance services. In the assurance services, there are attest services. In the attest services, there are several things that will be done, such as attesting to management's assertion about internal control, the next one attesting to a forecast, and the next one reviewing interim financial statement. The engagement audit will audit the financial statement. When doing auditing as assurance services, there are several things will be due, such as audit the financial statement audits of internal control over financial reporting. When we do the assurance services, attest services, and audit engagement, it will be supported by accounting and communication. This thing compiled financial statement with no assurance. The next one, the accountant value chain. There are 5 accountant value chain in this slide and in the figure. The first one, business event. The next one, data. After that, information, knowledge, and the last one, decision. In the business event, capturing business event in the form of data. This is the job of the accountant and accounting information and communication system. In addition, many internal controls function at this level to ensure that accounting data are accurate. And the next one, data. The communicating the total picture with integrity and objectivity. This is the process of developing financial statement and other information that might be reported to management, the board of directors, or outside creditors and investors. The next one is information. Information is transforming complex information into knowledge. It means that this is the process of provide a context for information and making it usable. An example of the third step might be determining that a company turns inventory 4 times a year. And anticipating and creating opportunities. If a company is turning its inventory 4 times a year, and that is slow for the industry, then the next question becomes one of determining how to increase inventory turns. And the last one, decision making. Ultimately, management decides on a course of action to improve inventory management. Management must make the sales and streamline the inventory management process to improve inventory turns. The role of the financial statement audit is to provide reasonable assurance that the information sets known as financial statement prepared in accordance with GAAP are presented fairly in all material respect. Reliable information is the foundation for many decisions. The purpose of an audit is to provide assurance that information used in decision making is reliable. Without audit, outsiders who use information provided by management may not have an adequate foundation on which to make important decisions. Okay, the next presentation will be delivered by Arif Nurrahman.
Okay, thanks Hadian. We next to the roots of auditing. British influence and migration. The beginning of the company audit can be linked to British legislation during the Industrial Revolution in the middle 1800s. Advance in transportation and industrial technology result in new economies of scale, larger companies, the advent of professional managers, and the growth of the first absent ownership of companies. The development of professional managers who were separate from investors and creditors created a demand for someone to add credibility to management's financial representations. Initially, company audits had to be performed by one stockholders who were not company officers and who were designated by the other stockholders as their representative. The British influence migrated to the United States in the late 1800s as English and Scottish investors sent their own auditors to check on management states invested. The focus of these early audits was on finding errors in the balance sheet accounts and stemming the growth of fraud associated. With the increasing phenomenon of professional managers and absent owners, during the early 1900s, the demand for audits expanded greatly owing to rapid growth in the public ownership of corporate securities. Following the stock market crash of 1929, significant deficiencies were recognized in financial reporting, and the provisions was challenged to provide stronger leadership in the further development of accounting and auditing. By then, the income statement had gained status, and attention had to be paid to measures of operating performance and concept of income as well as financial condition. Passage of the Securities Act of 1933, the Securities Exchange Act of 1934 further added to the demand for audit service for publicly owned companies. In response to this demand and growth, with the size of complexity of business by the 1940s, three important changes in audit practice had involved. The first one, a shift from detailed verification of accounts to sampling or testing as the basis for rendering an opinion on the fairness of financial statement. The second one is development of the practice of linking the testing to be done to be the auditor's evaluation of a company's internal control. And the last one, the emphasis of the detection of fraud as an audit objective. In the 1980s, the auditing profession came under scrutiny by Congress following discovery of financial fraud at several public companies such as Equity Funding and National Student Marketing. At this time, the public accounting profession took another step in ensuring high-quality audit service. Various steps adopted requirements that CPAs engage in annual continuing professional education in order to maintain their license. The public accounting professions also took a voluntary step by instituting a program of peer review. Under this program, a CPA firm would submit its accounting and auditing practice to a review by independent peers every 3 years. During the 1980s, the accounting profession slowly addressed the issue of its responsibility for finding financial fraud. The National Commissions of Fraudulent Financial Reporting made recommendations for improvements in internal controls, and the Auditing Standard Board issued a series of 10 new auditing standards in 1988 to narrow a perceived expectation gap. From 1990 to 2000, CPA firms became professional service firms, hiring a wide variety by business professionals that sold consulting services to their clients. By 2000, consulting's revenues exceeded auditing revenues at all the national CPA firms, and in some cases, consulting fees to an audit client exceed the size of the audit fee. The SIC and the investing public began to question how CPAs should be independent on audit issues when the firms were so dependent on consulting revenues. Over the years, the demand for auditing has been influenced by professional managers who mislead investors by materially misstating the financial performance in their company's financial statements. The Sarbanes-Oxley Act of 2002 also extend the auditor's work beyond the financial statement audit. A number of important commissions have recognized the importance of good internal controls in preventing financial statements misstatements. Section 404 of the Sarbanes-Oxley Act of 2002 also requires auditors to audit management's assertions about the adequacy of internal controls over financial reporting. Okay, next we discuss about need for financial statement audits. There are four conditions. The FASB in Statement of Financial Accounting Concept number 2 states that relevance and reliability are two primary qualities that make accounting information useful for decision makers. Users of financial statement look the independent auditor's report for assurance about the reliability of information and its conformance to generally accepted accounting principles. The first condition, conflict of interest. Many users of financial statements are concerned about an actual or potential conflict of interest between themselves and the management of the reporting entity. The apprehensions extends to a fear that the financial statement prepared by management may be significantly biased in management's favor. The second condition is consequence. Published financial statements represent an important and, in some cases, the only source of information used in making significant lending, investment, and other decisions. Thus, users want the financial statement to contain as much relevant and reliable information as possible. And then, okay, we next to the condition 3, complexity. Both the subject matter of accounting and the process of preparing financial statement have become increasingly complex. Accounting for the impairment of fixed asset or goodwill and accounting for leases, pensions, and income taxes are examples of this complexity. As the level of complexity increases, so does the risk of misinterpretations and intentional or unintentional misstatements, finding it impossible to evaluate the quality of the financial statement themselves. Usually on the independent auditors to assess the quality of the information contained in the statements. And the last condition is robustness. Distance, time, and cost make it impractical for users of financial statements to seek direct access to the underlying accounting records to perform their own verification of the financial statement assertions. Rather than accept the quality of the financial data of FITE. Once again, users rely on the independent auditor's report to meet their needs. These four conditions collectively contribute to information risk, which is the risk that the financial statement might be incorrect, incomplete, or biased. Thus, it can be said that financial statement audits enhance the credibility of financial statements by reducing information risk. Okay, we next to the economic benefits of an audit. The first one is access to capital markets. As not previously, public companies must satisfy statutory to audit requirements under the Federal Securities Act in order to register securities and have them trade on securities markets. In addition, stock market might impose their own requirements for listing securities. Without audits, companies would be denied access to this capital market, and many audits and many private companies will be denied access to loans. And then the second one is lower cost of capital. Small companies often have financial statement audits to obtain bank loans on more favorable borrowing terms. Because of the reduced information risks associated with audited financial statements, creditors might offer loans with lower interest rates. And the third one is the turn to inefficiency of fraud. Research has demonstrated that when employees know that an independent audit is to be made, they take care to make fewer errors in performing accounting function and are less likely to misappropriate company assets. Thus, the data in company records will be more reliable, and losses from embezzlements and the like will be reduced. In addition, the fact that financial statement assertions are to be verified reduce the like that management will engage in fraudulent financial reporting. And the last one is control and operational improvements. Based on observation made during a financial statement audit, the independent auditor often makes suggestions to improve internal control, to evaluate management's assessments of business risk, to recommend improved performance measures, and to take recommendations to achieve greater operational efficiencies within the client organization. Because these benefits are especially valuable to small and medium-sized companies. Okay, we next to the limitation of an audit. A financial statement audit is subject to a number of inherent limitations. One constraint is that the auditors works within fairly restrictive economic limits. Following are two important economic limitations. The first one is reasonable cost, and the second one is reasonable length of time. Reasonable cost is a limitation on the cost of an audit result in selective testing or sampling of the accounting records and supporting data. In addition, the auditors may choose to test internal controls and may obtain assurance from a well-functioning system of internal controls. And reasonable length of time, the auditor's report on many public companies is usually issued 3 to 5 weeks after the balance sheet date. This time constraint may affect the amount of evidence that can be obtained concerning events and transactions after the balance sheet that might have an effect on the financial statement. Moreover, there is a relatively short time period available for resolving uncertainties existing at the statement date. And then another significant limitation is the established accounting framework for preparing financial statements. Following are two important limitations associated with the established accounting framework. The first one is alternative accounting principles. The second one is accounting estimate. Alternative accounting principles are permitted under GAAP. Financial statement users must be knowledgeable about company accounting choices and their effect on financial statements. And accounting estimates are an inherent part of the accounting process, and no one, including auditors, can foresee the outcome of uncertainties. Estimate range from the allowance for doubtful accounts and inventory obsolescence reserve to impairment test for fixed asset and goodwill. An audit cannot add exactness and certainty to financial statement when these factors do not exist. Okay, now we discuss about organizations associated with the public accounting professions. Okay, there are two sector organizations. The first one is public sector organization, and the second one is private sector organization. Now we are discuss about public sector organization first. Securities and Exchange Commission is a federal government agency that was created under the 1934 Securities Exchange Act to regulate the distributions of securities offered for public sale and subsequent trading of securities on stock exchange and over the counter market. And then we next to the state boards of accountancy. There are 54 boards of accountancy, one in each state, one in the District of Columbia, and one in each U.S. territory. The primary function of the state boards of accountancy are issuing license to practice of a CPA, renewing license, and suspending or revoking license to practice. State board usually consists of 5 to 7 CPAs and at least one public member who are generally appointed by the governor, a full-time administrator, and a small administrative staff are common. Each board administers state accountancy laws, which set forth the conditions for licensing of CPAs, codes of professional ethic, and in most cases, mandatory continuing professional education requirements. And then, U.S. General Accounting Office, or GAO, is the nonpartisan federal audit agency of the U.S. Congress, headed by the Comptroller General of the United States. The GAO has the authority to issue standards pertaining to the audit governmental organization, programs, activities, and functions. Its standards have been published in a booklet called Government Auditing Standards, also known as the Yellow Book. And then Internal Revenue Service, or IRS, is the division of the U.S. Treasury Department responsible for administration and enforcement of the federal tax law. Then next to the state and federal courts. Occasionally, CPA firms are sued for alleged substandard work in performing audit or other service. In reaching a judgment in a particular case, generally the courts have looked to the standards of performance established by the professions itself. And the last of the public sector organization is U.S. Congress. Following a number of widely published audit filers, congressional committees have undertaken several investigations of the accounting profession over the past 2 decades. The investigation have focused on such matters as the independence of CPA firms, their effectiveness in auditing public held companies, and their responsibilities for detecting and reporting fraud and illegal client acts. And then we move to the private sector organization. There are the Public Companies Accounting Oversight Board, or PCAOB. Is a private sector non-profit corporation created by the Sarbanes-Oxley Act of 2002 to oversee the auditors of public companies in order to protect the interests of investor and further the public interest in the preparation of informative, fair, and independent audit reports. And American Institute of Certified Public Accountants, or AICPA, as stated in its annual report, two missions of the AICPA is to act on behalf of its members and provide necessary support to assure that CPA serve the public interest in performing quality professional service. And then the third one is State Societies of Certified Public Accountants, or CPAs. CPAs within each state have formed a state society or associations of CPAs, as in the AICPA. Membership in state society in voluntary, and many CPAs are members of both the AICPA and a state society. And then the practice units, or CPA firms. CPA firms may be organized a proprietorship, limited liability partnership, professional corporation, or any other form of organization permitted by state law or regulation. And then accounting standard setting bodies. The Accounting Standard Board, FASB, and Governmental Accounting Standard Board, GASB, are independent private sector standard setting bodies whose primary functions are the development of generally accepted accounting principles for business and not for profit entities and state and local governmental entities, respectively. The statement and interpretation issued by both boards have been officially recognized by the AICPA as constituting GAAP. Okay, we next to the regulatory framework for ensuring high quality service. There are standard setting, firm regulation, inspection and peer review, and then the last is government regulation. Standard setting is the private and public sector established standards for accounting, professional service, ethic, and quality control to govern then the conduct of CPAs and CPAs firms. Firms regulation is a HCPA's firm adopts policies and procedures to assure that practicing accountants adhere to professional standards. And then the third one is inspections and peer review. The PCAOB and the AICPA have implemented a comprehensive program of inspection of audit by PCAOB staff and peers in other accounting firms. And then the last one is government regulation. Only qualified professionals are licensed to practice, and auditors' conduct is monitored and regulated by the PCAOB, State Board of Accountancy, and the courts. Every professions is concerned about the quality of its service, and the public accounting profession is not exception. Quality service are essential to ensure that the profession met its responsibilities to general public, clients, and regulators. Okay. Next to the last slide, standard setting organization in the United States. There are public companies and private companies. For the accounting, public companies use FASB, GASB, and SIC, but in private companies, they just use FASB, GASB doesn't use the SIC. And then in the auditing, quality control, ethic and professional conduct, public companies use PCAOB, but private companies use AICPA. And then in the last, other awareness and assurance service, both of them use IACPA. Thanks for your attention.
Wassalamualaikum warahmatullahi wabarakatuh.